Welcome to our Chapter 2 lecture where we're going to go deeper into the basic tax calculation that we covered in Chapter 1. We'll do that by going over the basic versus the expanded formula for tax calculation and also looking at an example and looking at the old and new tax forms to understand the concept of AGI and the calculation. And this will include going through the filing statuses, dependents, both qualifying child and qualifying relative rules, standard deduction versus the itemized deductions, estimated tax payments, and penalties. So we'll start with the basic and expanded tax formula and the tax forms. So we started out with this basic tax formula. Total income minus permitted deductions equals taxable income times appropriate tax rates, which essentially is using the marginal rate and then plus the rate that applies for each amount of income earned, which we can do on the tax tables for people with 100,000 taxable income or less. That equals our tax liability, and then we can subtract out tax payments, which includes W-2 withholdings and credits, and that equals a tax refund or amount due. Now our expanded tax formula, which really more fits the tax return here in Chapter 2, is gross income minus these permitted deductions for gross income equals adjusted gross income, AGI, which is an important amount in calculating many deductions, credits, etc. From here we minus the standard or the itemized deductions, whichever is greater. Unlike many things in taxes, it's whichever is greater. We've had some changes to the standard deduction, which we'll talk about later. This equals taxable income times those appropriate rates using the table equals tax liability minus tax payments or withholding plus other taxes like self-employment tax or retirement taxes minus tax payments and refundable credits, which equals a tax refund or an amount due if you did not withhold or pay in enough taxes and have enough credits to cover the tax liability. So let's look at an example. Jones is single with 2 dependents. During 2018 has gross income deduction for AGI of $3,000. Itemized deductions are $13,500. Tax credits of $4,000. $7,895 taxes withheld. Now, the answer to this is that they have a refund of $5, but we want to make sure you know how to get there. Now, I recommend using this formula on paper when doing these types of problems. So we start with that gross income number and we just plug it in here. Then we subtract our $3,000 to get adjusted gross income of $96,800. Their itemized deductions is $13,500. However, we need to see what the standard deduction is to see if it's greater. Now you want to assume that this person will qualify as head of household because it says that they are single and have 2 dependent children and they qualify to take tax credits for these children. So that will mean that we'll assume that they qualify for the standard deduction head of household, which is $18,000. So minus our greater amount equals our taxable income of $78,800. So we need to use the tax tables to calculate the appropriate tax rates and tax liability of $11,890. Once you get this correct tax liability amount, we can subtract the tax withholdings of $7,895 on paychecks. There's no other taxes to add in, but we can subtract out those tax credits of $4,000, and of course $4,000 plus $7,895 is $11,895, $5 more than the total tax on the return, which means $5 refund. So to figure out which amount to take from the tax tables, which we have to use because we have less than 100,000 of taxable income, we first look at this first section and then the second section for the amount. we look at line 10, taxable income, at least this amount, but less than this amount. So that means that the amount right here, 78,050, is repeated here. So if you fall on this line, you don't go here, you go to the next line. So if we come down here, 78,800, it is on the cusp. So you don't use it because you don't use this line because it's here. You go down to this line. And then, based on the filing status, single, married filing joint, married filing separate, and head of household, we come over here, and this is the amount, 11,900. And you can find these in the instructions for the Form 1040 or at the end of your textbook or the online textbook. So now we're going to take a look at the old tax form, Form 1040, versus the new tax forms. Now here we can see page 1, which has general information here, income, deductions for adjusted gross income, and then we calculate the tax and refund or amount due and sign the return. Now our new forms, as we've gone over, are a bit different. We have 2 half-page returns, the first page being only personal information, second page being only amounts. And then we have Schedule 1, which primarily covers the information that was missing from page 1 to get us to this AGI. And we have 5 more schedules. All of these things being stuff that was on these 2 pages. So the point of the tax changes was to be simpler, and they actually took away Form 1040A and 1040EZ, which were for simpler situations. I think it's more difficult to understand this adjusted gross income AGI concept on the new forms, so we're going to look over the older forms to explain the concept of AGI. And you need to know which schedules to attach based on which items you have. So we'll look at that as well as we go take a look at the formula. Okay, so we'll head down here at the irs.gov and we'll head down to Form 1040 and Schedules 1 through 6. Now we'll click Search Forms to get an old 1040, prior, search, 2016. Now, if you see here, we have personal information, filing status, exemptions, which include personal exemption and dependency exemption. We'll be talking about that more. A summary of all income amounts. We still refer to some other forms, but those are still being used on the change forms as well. Then we have a summary of all deductions for this adjusted gross income. That's what we're calling permitted deductions on our tax formula. However, these amounts are rather valuable because they lower this adjusted gross income amount. Now you can see that adjusted gross income amount is repeated on page 2 of the old form. And then we have our calculation here, itemized or standard deduction, whichever is greater, and the standard deduction is listed on the left. Then we include our exemptions, which was in 2016, 4,050 per dependent and person on the return. So if a couple's married, they would have gotten 2 of those. If they have 2 children, then they would get 4 of those in addition to their 12,600 standard deduction. So from there we go to taxable income and then tax. Then we have alternative minimum tax, which is a special situation we may get into later. We have some tax credits, which reduce that tax. And then we have other taxes that are added in, self-employment, retirement, and some other things as well. Our healthcare tax credit being adjusted if necessary. And then payments, including the amounts withheld and estimated tax payments, as well as some other tax credits that are refundable, therefore counting as payments. And here we have a calculation of the refund or amount you owe, third-party designee, and signatures. And if you paid someone, they need to sign last too. So now we'll go back in here, and now that you can see how that AGI is the middle of those two forms, we'll take a look at Form 1040 now, and we will go over how you know which schedule to use. So if you have anything listed in this section, then you need to file the schedule listed to the right. Now, to do the AGI concept, we're going to need Schedule 1 in the new 1040. So now you see we have our personal information and we have our dependent information. Even though it's not used for personal exemption anymore, it's used for so many other things that it couldn't be thrown away, so to speak. So then we have our signature and paid preparer. Now notice that our third-party designee actually now requires Schedule 6 to be attached. Now, if we come down here to our adjusted gross income calculation to see where it is on this form, we have lines 1 through 6 of income, and then we have to add in an amount from Schedule 1 if we have any of these other items. Then to get our adjusted gross income, which is reported on line 7, we take the amount on line 6 and we subtract line 36, our adjustments to income deductions for AGI. We subtract this total from right here from line 6, and normally that's on the form, but it's not on the form now, and instead we just report that adjusted gross income on line 7. So you can see this is a big difference on the Form 1040. Now we're getting to adjusted gross income in line 7, but nothing for the calculation has changed. It's just this presentation now requires this schedule and the 1040 and whatever other schedules are required here, all of these that will be behind that schedule. So from there, you continue down, calculate taxable income on line 10, tax on line 11, and then we have other taxes being added in, our withholding, refundable credits, and then our refund or an amount you owe, and that is all. Okay, we're going to jump back in now that you know how to choose which schedule to use here. You can see that screenshot of all of the categories for which schedule on the new. So you can see that screenshot here for what you have on your return and the schedule that you need to use. So be sure to review that. And then this I thought was a very helpful line by line of the returns now on of the activity that's now on the new tax return. And this is from the textbook. And then they also refer to the chapter and page number where we're covering some of this stuff. So that's why a lot of the returns are actually pretty simple, because we don't cover all the calculations up front. So that's it for our tax calculation. Now let's jump into filing status and the standard deduction. So there's a few filing statuses, and filing status is important because it's used to determine many things, including the standard deduction amounts, other calculations for limits, limitations, deductions, credits, and it's used for the tax liability amount to determine the amount of tax. Now your status is determined as of the last day of the year, literally the last day. December 31st, 2018, were you single? Were you married? Sometimes people are like, but that doesn't make sense, you know? But that's the way it is. We had to pick something, and that's what they picked. Now, choosing a filing status is not subjective. There's many rules. So there are 4 essential filing status categories, but we have 5 actual groups. So there's single, married filing joint, married filing separate, head of household, and qualifying widower. Now, basically what happens is the qualifying widower gets to file as married filing joint, and so it's number 2 and 5 are essentially one category for most amounts and things like that. So first, to be single, you have to be single on the last day of the year. You don't qualify for any of the other statuses. If you are legally separated from a spouse under a divorce decree or separation maintenance, then you file as single because you are legally single. It goes based on state rules and state law. So this must be in the process, though. This must be final, not in the process. If this is just in the process and hasn't been finalized, they're still married. We'll talk about that next. Married filing joint, which I'll be initially an MFJ, means that the couple files one tax return together, the same as filing single. Only instead, now both spouses file on one return, reporting all income, all activity together, even if one spouse had no activity and one spouse had a lot, or whatever the situation, it doesn't matter, they file together. So even if they got married on 12/31, it still counts. And again, marital status is determined by state law. So in the year a spouse dies, the surviving spouse can still file MFJ for that year. And then that's where our 5th filing status will come in. We'll talk about that in a moment. And you cannot file MFJ if you have a divorce decree or separation maintenance, as we mentioned, for single, because you're required to file single. MFS, married filing separate. So this is how married filers can file separate returns. They cannot file as single. They have to file MFS. Now, they can use this status. They must have the other spouse's social security number. And this really isn't so much of an option as a last resort. It tends to be very disadvantageous. So if one taxpayer uses the itemized deduction, the other taxpayer must too. And oftentimes only one spouse has itemized deductions like property taxes, mortgage interest from owning a house, which means that the other spouse essentially loses a standard deduction. So there's also many tax credits and deductions that are completely eliminated or reduced because you're filing MFS. So it will rarely benefit a couple to file MFS. A lot of times couples want to try it. They can try it. There are a few rare situations where it actually does work out in their favor, but it's so unlikely for the common person for common couple for that to be the case. Number 4 is head of household, and the amounts for head of household are basically in between single and married because they give you credit for maintaining a household for a dependent person called a qualified person who lives in that home for more than half the year. So this is the general definition. So you must be unmarried at the end of the year. A married taxpayer cannot have lived with a spouse since June. There is an exception that allows a married taxpayer to be able to file if this is the case and they are truly separating. Now, they must be a U.S. citizen or resident, the qualifying person. Must maintain a household for this qualifying person for more than half of the year. And the qualifying person is a specific qualification for this filing status. Now, parents can live in separate household and qualify in certain scenarios for a parent of the taxpayer. So I'm going to break down these 3 requirements again in a little more detail. Number 1, you must pay for more than 50% of the cost of maintaining a home. So that includes these household costs, rent, mortgage, utilities, home insurance, repairs and maintenance, groceries, property taxes, common expenses, non-qualifying expenses, personal expenses, clothing, medical, transportation. So the person must pay more than half to maintain a home. Now, for this qualifying person, they must be a child, which can be step or foster or adopted, a sibling, or a descendant of either. A descendant of a sibling or a descendant of a child, grandchild, niece. Citizen of U.S. or resident of U.S., Canada, or Mexico. Age, under age 19 or 24 if in college, or any age and permanently disabled. The support test. The taxpayer must provide more than half the support of the household for this qualifying person. Now, if the person is a qualifying relative, then they cannot have provided more than half of their own support. Now, a joint return for this qualifying person cannot be filed unless it was only to get withheld taxes back. They had no actual tax liability. Those rules are going to sound familiar when we go over the dependent rules, but they are a bit different here. So you must be considered unmarried, but there is this exception for separated but legally married couples. So if the following is true, then you may still be able to file head of household. You will not file jointly with a spouse and didn't live at home with a spouse after June because you're separated. Only in-home children relatives qualify. So they would have actual child, and everyone explained in number 2 qualifies. And you are the custodial parent, and you qualify to claim the child as a dependent even if you're not. Now, what custodial parent means is that the child stays with you for more than half the year. Most years have 365 days, which means there has to be one more day. And typically, if people really document the days that a child stays with them, one person has them more between vacations and work and changes in schedule and that sort of thing. Basically, the IRS favors the custodial parent over whatever a divorce agreement says. Okay, so that brings us to our 5th filing status, qualifying widow, which is also called surviving spouse and abbreviated QW. Now, this one again meets the same criteria as married filing joint. So in the year the spouse dies, the surviving spouse can file joint for that year. For the following 2 years, second and third tax years after the death, the surviving spouse can file with this filing status if they were not eligible to file a joint return in the year the spouse died, they haven't gotten remarried, if they were if, number 1, they were able to file a return that first year when the spouse died, did not remarry after that, paid more than half the cost of keeping up a household, same expenses as had a household qualify, and household was for both this a living surviving spouse and a qualifying dependent who is a child, which can be a stepchild or an adopted child as well. Next, we're going to talk about the qualifying dependent rules. We will come back to filing status when we talk about the standard deductions. Qualifying dependent rules. So what does it mean to have a dependent? A dependent means that you take care of someone, you support them, and so therefore you get a benefit on your tax return for doing so. Essentially, it's called claiming someone on your return. And we actually no longer have this, but it was called the personal exemption concept, which was that everyone got a personal exemption of what would have been this year $4,150. And that is a deduction, but it is not give you anything back unless you earned money to deduct from. So if you have zero income, it does nothing for you. It's just a $4,150 deduction if you had income. Last year it was $4,100. Now, every person gets one to cover basically basic expenses. And if you take care of, say, 3 people and you meet some of these rules for a dependent, then you could take their personal exemptions on your return because you take care of them and spend money on essential things for those people. So for 2018, this personal exemption was removed. And there's a lot of talk that the standard deduction was made greater without bringing up the fact that the personal exemptions were removed. So a married couple, even though the standard deduction was kind of half of what it is now, and we'll look at those differences in amounts, they would have also gotten 2 personal exemptions for $8,200, nearly $20,000. So it is deceptive how the standard deduction looks much larger. So there's no more real dependent deduction, but we still have this concept of qualifying as a dependent because it applies to so many other things. So qualifying as a dependent. To qualify as a dependent, someone must meet 3 basic tests, which I'll cover down here below, and either the qualifying child test or the qualifying relative test. So to claim someone, they must be first and foremost not a dependent of someone else, dependent taxpayer tax, not file a joint return except for a refund, joint return tax. And all that means is that they're not actually paying tax liability on a return. If they have tax liability, then or they're required to file, then this doesn't count. It's only if they made very low amounts and they're not required to file, but they're doing so for a return. And number 3, the person that they want to claim as a dependent must be a U.S. citizen, resident or national, or resident of Canada or Mexico, or an adopted child who is a member of the household all year, even if they are not a citizen or national of North America. So once you meet those 3 tests, right, dependent taxpayer, joint return, and residency, then you must also meet one of these 2 tests, which we'll go through now. So the qualifying child is 5 tests: relationship, age, residency, support, and qualifying child of more than 1 taxpayer special test. The relationship. So for the qualifying child rules, the relationship of the dependent must be a child or descendant of, like grandchild, stepchild, foster child, or sibling or descendant of. So brother, sister, niece, nephew, child, grandchild. No one else. The age test, qualifying child test. So under age 19 or under age 24 and a full-time student, which means full-time as defined by the school for 1 semester, 5 months during the year. Or any age if they are permanently and totally disabled, which is kind of according to SSA, Social Security Administration. And there was this rule added a few years ago that the person must be younger than the person claiming the dependency. Residency. So the qualifying child must have lived with the taxpayer for more than half the year, and you got to literally count the days. That's the custodial parent. Temporary absences do not count if they are actually maintaining a home at that person's house. If they're not actually maintaining a home, then it doesn't count. And this can be due to education, vacation, illness, or military, which I didn't think military counted, but the book here, our book says it does. So an example is living at college. As long as the student is actually still living at home, then they would still qualify. Now the support test. For the qualifying child, the support test means that the child must not have paid more than half of his own support. This is a more lenient requirement than the support test that we have under qualifying relative. So this includes food, shelter, clothing, medical, education, and the like. Basically what you have to do is you have to list out all support, add it all up, and see if the child pays more than half. If so, they don't qualify under the qualifying child rules. So life insurance expense is not included. Scholarship income, not included if the not included for income in supporting the child if the child is a full-time student. So that's beneficial to the student. Life insurance expenses being excluded would be less beneficial. But how many children have life insurance? Very wealthy ones, usually. So qualifying child of more than one taxpayer. This is our fifth and final test for the qualifying children test. If a child qualifies for two people, then the taxpayer can decide who claims the child. But if they can't decide, then the IRS decides using the tiebreaker rules. So if one of the people that qualifies as a parent, that person wins. If both of them are a parent, then the custodial parent wins, the one with whom the child stayed more nights during the year. If they are truly all equal in time, then the parent with the highest AGI. Now let's say the people who qualified weren't parents, then the person with the highest AGI. So now we'll go into the qualifying relative tests. There's 4 of these. So let's say something about the qualifying child throws the dependent out, they don't qualify. You can move on to the qualifying relative test and see if you can meet under this test. So number 1, they can't be a qualifying child. That is supposed to say child. So they don't qualify as a qualifying child. Relationship or member of household for the entire year. So what this means is they either meet a relationship test or they are unrelated to you, but they live in your household for the entire year long. That's how you can claim someone who is not actually related. 3, gross income. They can't have earned income more than $4,150. And if you recall, this number should sound familiar. This is the amount that the personal exemption would have been this year. And that would have also been dependency deduction. Now the support test, which is going to be a little different. You determine total support. Did the taxpayer pay 50% this time instead of the dependent? So that could be a little harder to meet, but if you truly have someone as a dependent, it shouldn't be a problem. So the relationship, I just want to compare the qualifying child, which we just went over, to the qualifying relative. So qualifying relative includes any of the qualifying child, plus parents, siblings and children, and in-laws, aunts and uncles, and the unrelated if they live with you all year, or distant cousins or more distant family if they lived with you all year. So with the support test, there are 2 exceptions. The first one is if several people total more than 50% of support of the dependent, but not one, then they can agree who can claim the dependent child as long as that person pays at least 10% of the support. Now this is called a multiple support agreement and it must be in writing, and you can use form 2120, and the person who claims the person as a dependent should file that with their return. The second exception is children of divorced or separated parents. Now this can be a qualifying relative of a non-custodial parent if child has been in custody of one or both of the parents for more than half the year, either or both parents provided more than half the child's support, and parents are either divorced or legally separated or separated under a written agreement or living apart at all times since June, and the agreement states either the non-custodial parent can claim the child or the custodial parent chooses to relinquish the claim in writing. And what that means is that the IRS basically says, we don't care if the divorced parent has something saying that they can claim the child. We give it to the custodial parent, as long as they're truly separated, and that's what those other tests were about. All right, standard deduction. First tax bracket used to be a 0% taxes, and so that's been replaced with tax 10% bracket. So now we have these deductions that apply to everyone. So here you can see the list of filing statuses, and you can see qualifying widower is the same as married filing joint. And you can see the amounts. Now these are the 2017 standard deductions, okay? But remember, everyone got either a personal exemption, and if they took care of a dependent and they had a qualifying dependent, they could take that dependent's personal exemption because everyone got one. So these amounts could go up much more. Now the benefit to this, remember, you get to take itemized or standard deduction, whichever is greater. So these numbers being a little smaller and being able to take these two means that your itemized deductions could be greater, and you could end up with more deductions. The new 2018 standard deduction amounts are larger, but we got rid of that personal exemption. So the standard deduction amount also increases for people who are 65 and older, or blind, or both. If they're both, they get more as well. Now, if a taxpayer can be claimed as a dependent by another taxpayer, their standard deduction is going to be limited to the higher of $1,050 or the taxpayer's earned income plus $350. And that's because in the past they were a dependent of another person. Tables in the IRS resources, you can look at Pub 501 for all of this information that we're covering. And so the additional standard deduction amount for single and head of household, it depends on your filing status, is $1,600 per incident. So if you're over age 65 and you're blind and you're single, you would get 16 plus 16. If you're married filing joint, married filing single, or qualified widower, you get $1,300 per incident per person. Of the couple. Okay, lastly, we're on to estimated taxes and penalties. So the basic concept is that taxes are a pay as you earn, and that our system is meant to be based on the ability to pay. We don't want to put people in a situation where they need to pay taxes and they don't have the money. That goes against the fundamentals of our tax system in a democracy. So you're required to pay as you earn because it's much easier to pay as you earn. So how is it required? Well, employers can withhold it from your paycheck, or you're required to actually pay it in quarterly, just like your employers do when they withhold it for you on April 15th, June 15th, September 15th, and January 15th. So they're not perfect quarters, but they're close. So employers can withhold it, or you can request estimates to be withheld from payment. So if you're getting a retirement distribution, you can call them. If you're getting unemployment compensation, you can call them and ask them to withhold estimated tax payments. And you can also make quarterly tax payments directly, which is what self-employed people have to do. You can make those through many different organizations directly to the IRS. So you're required to pay as you earn, but there's only a penalty under certain circumstances. There's a lot of exceptions to give people a break until they know that they're earning more money and they know the rules. So if you owe less than $1,000 in tax on your return when you calculate it, when you look at what was withheld from your paychecks, when you look at what was calculated in your return, if you owe less than $1,000, no penalty. Basically, you weren't required to pay in more. If you pay in estimates of at least 90% of the current year tax, no penalty. If you pay in estimates of at least 100% of your prior year tax, even if you owe 8 times that this year, no penalty. And so this really allows you to have a check, meaning as long as you pay in what you had on your tax liability last year, even if you make substantially more this year, you won't have any penalty. Now, if your AGI is above 150,000, then this 100% changes to 150. So we have some fees and penalties that we need to talk about. If you failure to pay estimated income taxes, the penalty rate is what is always the penalty rate, pretty much short-term Fed rate plus 3 percentage points. And this failure to pay estimated income taxes is calculated on Form 2210. It's quite complex. I've checked that form many times. It's always right, and it's very complicated. Now, this assumes that you earned your income evenly throughout the year, but you can elect to enter exactly how much you earned each quarter, so that it's based on the actual numbers. However, I will say the percentage is so small for most people that it makes rarely any difference. Assessments. So if you're filing and are paying late, an extension is an extension to file your return, not pay the tax. So you can file an extension before April 15th, and that means you can file 6 months later, October 15th, by October 15th, but that doesn't extend the time to pay the tax. So if you think you might owe tax, you should pay more in with your extension and then get a refund when you file later. And again, it uses that same interest rate. It's been averaging about 3 to 8% on the last 10 years. Basically, they're charging interest starting April 15th on any unpaid balance. So if you have an amount due, or you're late paying the amount or whatever. Failure to file penalty. So if you don't file a tax return, 5% of the amount of the tax due on the return is your penalty. And that comes out to 5% per month or portion of a month up to 25%. And once you're 60 days late, that's an automatic $210 penalty. Now, if you are doing this intentionally and fraudulently to evade taxes, then it increases to 15% a month up to 75% of tax due. So the failure to pay and the failure to file are interrelated and essentially equal to the failure to file amounts, because the failure to pay tax is actually deducted from the failure to file. So it's 0.5% of the tax shown on the return per month, max 25%. Failure to file is reduced by this failure to pay. So it's essentially the same as the failure to file. IRS will abate this failure to pay tax if the TP, taxpayer, shows reasonable cause for not paying, which is automatically shown by the amount being due is less than 10% of tax liability on the tax return. So they owe less than 10% of tax, and the balance due is paid when they file the return. Then this failure to pay tax is not applied. Other penalties, there are accuracy-related penalties, negligence or substantial understatement of income. These are reckless or intentional disregard for the rules, and they result in a higher penalty, 20% of tax due. A substantial underestimate is either owing more than 10% of tax on the return or more than $5,000. Now, fraud is an even higher level of disregard for the truth with this intent to evade taxes, and the penalties are higher, up to 75% of any underpayment, leading to criminal charges. And the penalty for erroneously claiming a refund or a credit is 20% of an amount that the IRS comes back and disallows. You get a 20% penalty if it was determined that you really did that intentionally and you knew that it was an excessive amount to claim. And that's all. We're at the end here. I hope you enjoyed lecture 2. I'd love to hear your questions in the comments below. And if you're going through any problems and you have questions, post them below as well. Be sure to check out the other videos for the tax returns for this chapter. Bye, guys.